Balance sheets. A business or company that is big or small will always need a continual update on its financial condition. Also called a statement of financial condition, this balance sheet can provide an accountant or entrepreneur with a moment-in-time picture of the aggregate assets a company is holding. A completed balance sheet has two sides. Assets on one side and liabilities and shareholder or owner's equity on the other. The balance sheet will always include these three items, so companies can track both the assets and the liabilities. A balance sheet gives insight to an investor on current value. If you were a shareholder of a company, you would want to know how the balance sheet is structured. You need to be able to analyze and read it along with the income statement and cash flow statement. Assets equals liabilities plus shareholder or owner's equity. The means used to operate the company are the assets, and they are balanced by a company's financial obligations or debt obligations and the equity investment, funds or cash brought into the company. Also, retained earnings are part of the balance sheet. The balance sheet is taking a photograph of the company's financial position at a single point in time. Assets that are current have a lifespan of 1 year or less, which means they are liquid and can be converted into cash. Assets are what companies use to operate their business. Liabilities and equity are used to support the assets. As you can see from the midstream balance sheet, cash and cash equivalents, accounts receivable, short-term debt, short-term client obligations, and inventories are part of current assets. Non-current assets include goodwill, patents, and other assets, such as machinery, building, and land. Long-term fixed assets can be used as depreciation. Long-term notes receivable collected after 1 year. Intangible assets that are amortized by a company for more than 1 year on an accounting schedule. Shareholders, a financial obligation a company owes to other would be the example of liabilities. They are current and long-term. Liabilities are shown clearly in the Pepsi Corporation balance sheet. Current liabilities are short-term obligations, accounts payable, retained earnings, and income taxes payable. Accounts are organized from short to long-term borrowings. Total current liabilities, the sum of accounts payable, accrued liabilities, and taxes. Long-term liabilities are the sum of these three. Total liabilities are the sum of total current and long-term liabilities, which may include bonds payable, mortgage payable, and notes payable. Shareholders' equity. What remains after all debts and creditors are paid? Shareholder equity is the difference between total assets and total liabilities. The initial amount of money that is invested in the business. Notice that shareholders' equity is added to total current liability and long-term debt. Total liabilities and equity are added together to equal $11,268, which is the exact same number as total assets, $11,268 for the year 2008, as shown above. Shareholders' equity is the difference between total assets and total liabilities on the balance sheet. The balance sheet can be used as a tool for investors. Financial ratio analysis can be used. The debt to equity ratio can give you a better idea of the company's financial condition and its operating efficiency. Working capital can be used as a financial strength ratio in meeting the debt obligations on time. By taking the liabilities and subtracting them from the assets, we can determine how much equity is available for each share. By dividing the subtraction, this number will give you the number of shares ratio analysis can help you obtain more information when investing in a company that is clearly building equity for the investor. Financial ratio analysis of debt to equity off of a balance sheet can determine the company's financial condition. Working capital can help determine the ability to meet debt obligations on time. Fixed assets, cash in bank, working capital, and shareholders' funds are all key aspects of a balance sheet. Reading a balance sheet. The balance sheet and the profit and loss account will show how healthy a business is. Shareholders, employees, customers, suppliers, and investors will all be interested in looking at balance sheets. Balance sheets help to gain insight into a company in regards to their operations, displaying what the company owns and owes in its financial position. There are drawbacks or limitations to what or how information is analyzed on a balance sheet, such as the recording of financial information on a historical cost. Estimates are used for some asset and liability information, which is not always accurate. The intelligence of the owner or entrepreneur is not included in a balance sheet. Why this company has a competitive advantage is also not available, but overall, a balance sheet is imperative as a snapshot for any company's financials. This is a tool for investors to gain insight into a company and the operations, displaying what the company owns and owes in its financial position. For an investor, this balance sheet may help them determine what numbers are real and what numbers are made up. To summarize a balance sheet, there are additional items that you may see in regards to assets. They may include inventories, prepaid expenses, and other current assets, short-term investments, contract costs, and recognized income not yet billed, costs in excess of fair value of net assets of businesses acquired may also appear. In regards to liabilities, you may also see capital and reserves. Capital or share capital is the investment from shareholders. Reserves comes from previous year's profit that has been held to finance future developments. A profit and loss account is cash held back from current year's profit. How are balance sheets arranged? They're usually arranged in a particular order, whereby financial statement elements are categorized into subgroups. This arrangement facilitates review of the balance sheet information by interested parties. The categories or subgroups included in the classified balance sheet may be as follows, as you can see on the chart below. Investors use balance sheets when evaluating or looking at the investment potential of a company. The balance sheet is used along with an income statement and the statement of cash flows. The balance sheet can tell the investor whether the company has the extra cash to grow or expand. When a large amount of liquid cash is on hand, growth would appear more realistic. An investor can also see how much equity the shareholders are entitled to. Investors truly looking for value in companies must always dig deeper. There are significant drawbacks in regards to the balance sheet value. You must consider that there are advantages of historical cost. Are they really there? Disadvantages of historical cost. Is low-cost debt an asset? We must continue to ask additional questions in regards to acquisitions, pooling versus purchase, specialized assets versus actively traded assets. Intangibles, credit ratios, and debt covenants must also be considered in regards to finding value. Real balance sheets show equity. It is true, assets minus liabilities equal equity. This statement is true, but a real balance sheet must show how equity has been built up by a company over the years. Stock sales and returned earnings would be examples of verifying that assets really equal liabilities plus equity. Thank you for your time.